Hello and welcome to a special edition of Market Masters. Is the worst over for markets? That remains the big question. Trump tariffs are the clear and present danger for global markets, while India middle-class tax cuts and potential RBI rate cuts are the two tailwinds which we can see right in front of us.
Absolutely. Today we have the top team at ICICI Prudential Mutual Fund joining us to discuss a whole range of issues, and they have assets under management of around 9 lakh crore rupees. ICICI Pru MF is the second largest mutual fund in India. Equity assets at close to 6 lakh crore rupees and debt AUM at around 2.5 lakh crore rupees. The AMC's equity PMS and AIF assets stand at around 33,000 crore rupees. So, Prashant, we're talking about some very large numbers and big money managers here.
And a big view then as well, right?
Yes.
I mean, and a rounded view, because we've got the equity managers, we've got the debt top leader as well. Let's welcome in Anish Tawakley, CIO, co-CIO equity. Anand Shah is CIO PMS and AIF, and Manish Banthia is CIO fixed income at ICICI Prudential Asset Management Company. Gentlemen, thank you very much, all of you, for being here on this special edition of Market Masters. And I think it's an important and interesting time to get that view from you, because so many people who write into us, who reach out, and the feedback from social media and otherwise seems to all point to this one question. Is the max pain over for markets? The maximum pain over? Is it behind? And while we may not be in a extremely bullish phase, are we to take that maybe, the worst is behind? Anish, let's start with you.
So if we look at the equity space, right, our view is that the large cap space is fairly valued, but one still needs to be cautious in the small and mid cap space. So that's the overall view. What is that based on? We expect the economy to regain momentum. Right. Our view is that there is no fundamental problem in the economy. There is no structural imbalance that needs to be addressed. Inflation is fine, current account deficit is fine, inflation expectations are reasonable, bank balance sheets are healthy, corporate balance sheets are healthy. So the only thing that's ailing the economy is weak demand. And weak demand is a relatively easily solvable problem if you get fiscal and monetary support. We do expect monetary support to be forthcoming. And if that were to happen, then we do expect the economy to regain momentum. So in that context, the multiples in the large cap space are reasonable, and if one invests for a sort of a 3-year horizon, returns should be reasonable. At the same time, we would say, look, some of the very exorbitant return expectations need to be moderated, right? So people were, over the last 3 years, had got used to very high returns, and that phase might also not be coming, as you were saying.
That's good to hear that you seem quite confident, Anish, on the underlying trajectory of the economy, and you say there's no problem. Let me quickly get in Anand's view on this as well. Anand, so that's the house call. Now, what is the approach that you're taking? And tell us a bit about what you've been doing through the phase of the correction as well. Have you been churning the portfolio a lot, or have you chosen to use this dip to add to some of your bets in infra and related areas that you've liked in the past?
Sure. Hi, good morning. So yes, as Anish said, look, the challenge with the market was there was unprecedented, if that's the word I would use. There was an exuberance in the market. You had a very solid 4-year runs in the market, but more importantly, for almost record 27 months, which is around from June 22 to September 24, we didn't have a 10% correction in the market. So I think the challenge with the market was not as much. I mean, yes, there was a challenge in terms of growth relative to what we have seen in the previous 4 years. The earnings growth rate was also very strong, 35% plus for 4 years. That's also sort of tapered down, but fundamentals in that sense were not like really challenged. The challenge was in the marketplace, which is the valuations and all that. So if I see the data, as on end of February, almost 80, while the markets are down 18.5, 18.8 odd percent, 80% of small caps, as I see, were down by more than 30% from their 52-week high. 60% of mid caps were down more than 30% from their 52-week high, and almost 50% of large caps were more than 30% down from their 52-week high. to that extent, that sort of over-exuberance, we believe, has sort of softened, or we've seen a quick reversal in the market. And to that extent, valuations in individual stocks, individual segments of the market have now corrected to make us a little more comfortable going into the markets, investing into the markets at this point of time. And that's what we've been doing. I think from here on, the key would be stock picking, and which was not even the case, say 12 months back, that if you were in a certain segments of the market, you have seen a lot more pain than otherwise. And that would remain the case even from here on. Even within the sectors, you will find winners and losers. And to that extent, going bottom up, doing stock picking would be much more important from here in the markets than just going in and out of the markets.
I have to ask you this, Anish and Anand. I mean, I think on the equity side, right? Those comments in early February, which got so much attention, it came from Nair, lock, stock and barrel out of mid caps and small caps. And it generated such a heat and debate all across. And Anish, you run the small cap fund, right? I mean, you guys have been cautious way before, and I think Nair was making this point for a while as well, that small caps and mid caps are very expensive. I mean, your small cap fund has been closed for subscription for almost a year now, Anish?
Yeah, almost exactly a year. You're right.
So, is the views still very strong, or are on mid and small caps? You said one needs to be cautious here. The preference is clearly large caps. But as Anand also pointed out, stocks have in the small cap space come off very sharply across the board. So, extremely cautious now. I mean, a little cautious, but maybe a little more attractive. What's the sense on small and mid caps?
See, I think the best way to put it is the risk-return trade-off is far more favorable in the large caps than in the small caps. In the small caps, you still have stocks that, if you look at price-to-book values, they're excess of 5, 8, and then you look at the moats of these business, the competitive position of these companies, it's not that great. If you look at the balance sheets, there's a lot of, stuff that you typically don't want: very high inventory levels, very high receivable levels. So there's enough minefields in the small and mid-cap space in our view. I mean, that's not to say that you can't find anything to invest in, but even in our small cap portfolio, if you look at the published portfolio, we have, a fair amount of large caps because we feel that overall they offer a better risk-return trade-off. So to the extent that's regulatory allowed, we have skewed even the small cap portfolio towards large caps and largish mid-caps.
Right. Okay. So, I mean, point taken. Manish, as Anish started by saying that there is no structural problem in the economy. Demand, though, is weak, and that needs to be fixed. And I think your view, Manish, also is that it needs help. I mean, the economy doesn't need saving, but it does need help, both on the fiscal side and monetary side as well. So, your thoughts there, Manish?
Right. So, we had a very good run in the economy in the last 2-3 years. Last 6 months has been a period of time where we've seen softening of demand. And, as Anish rightly pointed out, there are no major concerns. There was a period before 2020 when we were going through a balance sheet problem in India. Corporate balance sheet and the financial balance sheet both were under issue, and which is where the economy had a very slow growth for a particularly long period of time. At this juncture, we think that India is still in a mid-cycle. And what we are seeing is a mid-cycle slowdown or mid-cycle correction. And these mid-cycle corrections can typically be addressed if you have the right policy measure. So effectively, RBI has to cut interest rates. And rightly so, we've seen one rate cut, and we'll see more rate cuts till the point that demand in the economy starts to improve. I think additionally, fiscal policy is also important. While, fiscal was very high in 2021-22, the government rightly reduced fiscal deficits, over the next 2 years. But at this juncture, if we, concentrate on fiscal consolidation, the problem is the government revenue any which ways will start coming down because of the slow economic growth. And that will put additional pressure on the fiscal. To maintain the fiscal deficit, the government will have to cut expenditure at a point when the government, where the economy is at the margin slow. So I think government should not focus too much on consolidation at this point of time. Allow the fiscal to slip up a little bit and then allow consolidation when the growth is back. So you will have both fiscal policy and the monetary policy working at the same time. And, the RBI has also kind of, given liquidity back to the market. That should help the banks to allow flow of credit in the economy. So the combination of all of these should allow the economy to gain momentum back again. And that is, the broad view.
Absolutely. We've seen the signs of that easing, both in terms of the regulatory stance as well as rates themselves, Manish, in the last just couple of weeks, right? I mean, latest moves on the priority sector lending definitions and, of course, the rate cut itself. By the way, what is the House view? How many rate cuts this year?
So we expect, 2 more rate cuts from here. And then it will depend on how the economy behaves. The problem with monetary policy is it, works with a lag. So at some point of time, RBI will have to make an estimation in terms of how the forward-looking numbers are and therefore maneuver policy accordingly. At this juncture, given where, everything is, our expectation is that RBI will cut 2 more rates.
More rate cuts this year. Got that. Anish, so now, given what Manish has just said, I mean, let's apply that to the problem that you had identified. You said that the correction was because of market valuations, not because of any underlying economic issues. So on valuations and the earnings recovery, what are you anticipating? We're ending this year with very sluggish single-digit, nifty EPS growth. FY26, what's the recovery? And then do the valuations start looking far more palatable in that sense?
See, basically, but just to clarify one thing, Surabhi, I said that there was a demand weakness in the economy. I didn't say that there was no economic issue, but I said the only issue was weak demand, and that then reflected in slower earnings growth.
Yes.
Right? So, and we do expect demand revival. So, look, I mean, we do think the Indian economy can grow in real terms at 7-ish%, and add inflation to that. So, it was somewhere in the 11-12% range for nominal GDP growth is not unrealistic. And given that corporate earnings typically, follow that kind of growth, that would be the level we would expect nominal GDP to, corporate earnings also to grow at. See, the point on multiples is, I always say that, look, there's no, science to saying what is the right multiple, right? One can make a case for 21, one can make a case for 19, right? But the reality is if you stay invested for 3 years, even if you entered at 21 and 3 years later the multiple is 19, it's only a 10% spread out over 3 years. So it hurts your returns by 3%. But if you've got good nominal GDP growth, if you've got good earnings growth, you'll still make reasonable returns, right? So the point is there's no point endlessly debating whether the multiple should be 21 or 19. Reality is it's not outrageously high now, right? That phase is clearly not there. And it could sustain at this level, it could weaken a little bit, but either way it won't change your returns that much over a 3-year period.
Anish, you said earnings growth should be in line with broad GDP growth, but that still means that maybe
no, it could be a little bit higher. It should be, yeah.
Yeah, so in terms of a rough range number, do you think we're getting back to 15% earnings growth in FY26?
Let's see how quickly the economy regains momentum. As Manish said, right, there are lags between policy being eased and the recovery taking place. So, I think we should be picking up momentum, but whether for that year it ends up at exactly 15 or a little bit lower needs to be seen.
And just to add, even there is global commodities which will play a certain role. So, you really can't independently decide because there will be global commodity prices and movements which will also have an impact on the on a margin, not great, but on a margin on the Nifty earnings growth rate. So
Anish and Manish, we want to get to sectors and themes you like and you would want to bet on as well, although I think you kind of laid out how you think about markets in a broad way. But just one other big variable, Anand, you threw in the word global. Anish, so I want to ask you, Trump tariffs next week, it's the big talking point. But do you believe that it's going to be a disruptor, it's going to be a sideshow? Will it matter in a durable way, or it's going to sort of, pass in a day or two?
No, my view is that tariffs, as far as the overall economy are concerned, are really a sideshow. The economy is broad-based enough that it can withstand some tariffs. So I would make 3 points, right? Firstly, India lowering tariffs is not a bad thing for the economy, right? So even if we chose to lower tariffs, that would be fine. We've lowered tariffs from the 1990s, and the economy has done well. So nothing bad happens if you lower tariffs. Second, see the tariff debate. I think trade is one of the most misunderstood economic issues. It's always seen as one country gaining and one country losing. That is not the case. There are winners and losers within the country. And so if the US, for example, decided to impose steel tariffs, all downstream industries which use steel therefore suffer. So you might as well say that the US has made its own manufacturing uncompetitive by putting tariffs. If the US puts tariffs on pharmaceuticals, for example, more than 1/3 of the medicines they consume are supplied by India. There's no other place that can supply at the rates that India does. So what will happen if they put tariffs? The Indian manufacturers are not making supernormal profits. Demand is inelastic. So prices will have to go up. Right? So I think this tariff issue is just being discussed too much. At the overall economy level, I don't think it matters. And the third point, even if there is some reduction in US demand, right, for Indian products, if this domestic demand is strong enough, you can have greater policy support to make sure that the strength of domestic demand offsets the weakness of export demand. So from an overall economic perspective, I don't think tariffs will be the key factor affecting how the economy delivers or the returns that are generated.
Okay. And the point taken, policy support for domestic demand can offset any weakness to demand for Indian goods, right? That's broadly the view. Of course, sectorally, etc., we'll have to see, but more of a sideshow in a broader context, as far as the Indian economy is concerned. Okay, let's just drill it down to sectors and what you like as themes. Anish, one of the big bets for you has been real estate and housing, right? Have you seen, and we've asked company after company on the program, the channel over the last many weeks, has demand taken a bit of a knock, as wealth effect has taken a hit because of markets falling? What is your own sense? Because, that really has connections with so many other areas and it's so important for the economy as such. Has real estate and housing demand taken a bit of a hit, or does that remain in good state?
So it has softened a little bit, that there's no doubt. So what needs to be seen, right, is that if demand has weakened, the prices in the real estate market should be corrected, or there should be price flexibility downwards so that demand recovers. Actually, if we are sitting here 1 year later, right, or 2 years later, and the economy has not delivered, then the most likely cause of that would be that real estate prices remained stuck at a level where there were no volume of activity, or the volume of activity was subpar. Right? I can't see the economy doing well without good housing activity. At the same time, I can't see the economy doing poorly if housing activity is strong. Even this cycle, right, 3 years back, when you see it picked up only when housing activity started recovering, right? So if there is price flexibility downwards, developers, cut prices to ensure that sales continue happening, and they keep constructing, that would be good enough. The only point I'd make is, I'm not placing a bet. That doesn't mean you should invest in the housing sector or in real estate companies. The point is that is a driver for economic activity across the board. And you can play the cycle in other sectors also, because if housing recovers, other sectors will also do well as a result of the sort of spillover effect. So overall, I'm positive on domestic cyclicals, which includes automobiles, cement, financials selectively, and industrial and capital goods. What we are cautious on is FMCG, and we have been for a while, and IT.
Anish, you mentioned industrial and capital goods. There, the question is that, is one better off in the bigger private sector names, or do PSUs still have a big role in the portfolio? I mean, they've gone through a huge amount of price correction. The orders are still coming in because it's the end of the year. What's your call, PSUs?
So, PSUs across the board, we generally take, at least I take in my funds, a risk management approach. I don't increase the weight beyond a point, and I'm always comfortable with a certain sort of weight managed position in PSUs. And that continues to be the case. I mean, I don't think I've ever skewed the portfolio ever too much towards PSUs. But at the same time, I've never taken the approach that, oh, these are uninvestable and we should not have PSUs. Play it sensibly. When the valuation becomes too much, reduce the position. When the valuation is attractive, very attractive, increase the position. That's always my stance in PSUs.
And on financials, Anish, you said select financials. Can you elaborate on that point? Because it's a very wide basket from capital market players to insurance, where there's so many deals happening, to obviously the big banks. What is your order of preference there?
So within the lending space, right, I'm going only for deposit-rich financials. I'm still worried about unsecured consumer credit. So I'm avoiding names where there is a lot of exposure to unsecured consumer credit, particularly if the exposure has grown very fast recently, right? So I would like strong deposit franchises. And other financials, I mean, we like, basically, particularly insurance, we have an overweight on. See, basically, what I'm saying is if the economic activity recovers, right, both savings and investment pool increases, and there is a greater role for financial intermediation. So financials will do well, provided you avoid areas where there are clear credit risks, or if they are too reliant on, exuberance of capital markets, right? So overall, financials should do well. You should avoid areas where there is too much reliance on capital market activity or credit risks.
Fair enough. Anand, what is your view? Domestic cyclicals largely is what Anish has been pointing to. And I think you also are bullish on capex and industrials and capital goods and that kind of manufacturing as a theme, etc. as well. Although one difference I can spot, you like IT services. It's a bit of a non-consensus view. Anand?
No, actually that's not correct. We don't have IT services in the portfolio. I think within the manufacturing...
So what do you like, specifically pockets?
Yeah, so again, as I said, this is a nice time to be going bottom up. As I said before, that economy is not broken and it's sort of recovering from a slow growth. And with both RBI and government, some bit of support, the economy should improve. But also there will be enough divergence. So while we will talk about 12-13% sort of earnings growth rate, we will have segments being much better than that, and then there will be segments which will do far inferior. So again, within the manufacturing space, one area where we've been sort of overweight and constructive has been metals. I think that's a little bit of a non-consensus view that we have maintained, given that we believe that China, with its more, higher per capita income, more focus towards, lowering pollution in that part of the world, their competitiveness in general in manufacturing metal should reduce over time. And to that extent, we believe at some point of time the metal prices have to go up, notwithstanding tariff, which is also doing its own role. That's one area where valuations, we believe, were attractive. And as China recovers or otherwise, we believe the metal prices have to be going up as the costs of producing the same is going up globally, but more precisely in China. So that's another area that we like.
Okay, all right. That's a great perspective to have on equities. But Manish, we're also rounding up the financial year, and it's been one of those curious years where the Nifty return is about 7.5%. I mean, it almost is looking like fixed income type of returns. Gold has returned 40%. So the question is asset allocation, and looking forward to the next year, FY26, which asset class do you think could steal the thunder? And, also a brief outlook on fixed income itself. And what's the right mix that you would recommend?
Right. So at ICICI Prudential, we always believed in asset allocation. And the reason is that every asset class has a phase where it does very well. And why I say a phase is because there's a lot of behavioral element which get into an asset class. So for example, gold, I mean, we gave a positive call on gold in 22 and 23. And the reason for that was that, one, it has underperformed against a lot of asset classes at that point of time. And secondly, given that the uncertainty globally had increased, we thought that gold was a good hedge against, the financial assets. Now, gold has performed, as you said rightly, it has given, outsized returns against other asset classes. Do we see gold as the same hedge as it was 2 years back? I think the answer is no. You need to see the valuation when you look at each of the asset classes. And we believe in mean reversion. So while gold has done exceedingly well in the last 2 years, its ability to give a hedge on the portfolio has reduced meaningfully. I think fixed income looks pretty attractive at this point of time. And the reason we are saying that is, one, we are at a point where, we're seeing a mid-cycle correction. And, we also in the last 3-4 months had a problem of outflows. Now, those outflows also led to tightness of liquidity in, generally the banking system. That led to increase in spreads in the short end of the curve. When I look at, the 1 to 3 year part of the corporate bond market, I see a lot of value over there where, once, some of the liquidity which RBI has provided comes back into the banking system, as we go into the next financial year, the government spends that money. We'll again see that liquidity is easy, RBI is cutting interest rates, and people will then again go back to, protect their reinvestment. And therefore, I think in the very near term, fixed income returns look pretty attractive. Even globally, I think, when I look at US as well, when I look at the prices of equities and bonds, I think bonds have seen volatility over the last 2-3 years. Not that volatility in bonds will not remain, but pricing-wise, US treasuries look much more attractive than US equities. So I'm generally having a feeling that bond pricing globally, which were at 0% before 2020 in a lot of countries, they are now correcting. And as an asset class, bond generally looks much more attractive than a lot of places where, equity was more attractive 4 years, 5 years back.
And that's 1 to 3 year paper, right? That's where you're seeing the maximum amount of, possible excitement within the fixed income market.
Yes. So we generally track an indicator where we look at the spread between corporate bonds and the underlying, interest rate swaps. Now, interest rate swaps are plain vanilla instruments which expect, the amount of interest rate cuts and therefore the overnight rates over that period of time. And we're seeing that the spread is almost the highest in the last, 10 years. So we find that the 1 to 3 year AAA corporate bond space or the AA corporate bond space looks very attractive in the market at this point of time.
Okay, well, clear view and, bonds clearly more attractive, not just here, globally in the US as well. Appreciate your time, gentlemen, here on this special edition of Market Masters. Anish, Manish and Anand, thank you for being with us here. We'll, of course, get an update on these views as we go along and, of course, figure out where the market is headed as well. So interesting next many weeks and months coming up with lots of events lined up. Thank you very much once again. We'll take a quick commercial break here. Programming continues on the other side.